And I am going to get started. I know we have Jim and we might have another person over there trying to remedy this situation, but in the meantime, it's 1:05, so I'm going to get started anyway, and hopefully this will get fixed. Anyway, my name is Steve Papale. It's great to be here. It is Monday, August 26th, and today we're going to go over a topic that can be used for both traders and investors. And I wonder if it'll be, I keep reading all these chats. I apologize. We've got all these audio things. I'm going to have to kind of look past that. But we're going to use a strategy here that can be used for investing, but at the same time, it can be also used if you're a trader too, more of a short-term trader. So we're going to kind of go over that. Most of the presentation today is going to be on the PowerPoint. Okay, Pat, I've gone back and forth with the software. I'm going to jump over to the software at the end, but I've managed to kind of come up with a whole bunch of examples on the PowerPoint. So I think it might be easier that way, and it's not going to take anything away from the strategy or showing the strategy one bit. Okay, we just got an email here, a chat from Jim, who's our COO, regarding the audio. We record this. Okay, apparently this will be recorded and archived. So for those of you that don't get this and you can't hear my voice right now, this is going to be archived. All right, well, let's get started anyway. Let me get this thing moving through. The usual disclaimer, DiscoverOptions, we are an education provider. PLE Capital Management is our RIA, and information presented today will be for educational purposes only and does not intend to solicit any kind of offer of business. Investments involve risk, and nothing here is guaranteed, obviously. All right. No ducks, just profits. For those of you that are fans of Duck Dynasty, which to me is just the most crazy show. I love it, but it's unbelievable. These guys are laughing all the way to the bank. But today we're going to try to go for profits, and I'm not a hunter myself, but that appears to be a double-barrel shotgun. So we're going to shoot for profits. All right. What we're going to go over today is what I would call the normal way of stock investing, the normal, traditional way of purchasing stocks. All right, then we're going to go over two strategies that options traders use. Okay, the first strategy is put selling. Okay, and the cool thing about put selling is you can pick your price and you can get paid. Okay, you can get paid for this. We always get paid when we sell options. Okay, and then we're going to go over call buying. Okay, we're going to cover the good, the bad, and the ugly having to do with call buying. For those of you that have experience in buying options, specifically buying calls, maybe even naked calls, you know what I'm talking about here. Okay, then we're going to talk about this sort of double-barreled, high-caliber approach. Okay, that's kind of slick. It's kind of cool. All right, I'm going to jump. I'm getting massive chats here, or a few chats here. I may listen to the recording, but I'm not going to burn my minute. Okay. Yeah, I hear you. I guess the recording, we're going to have to send, for those of you who can hear me, we'll send out an email explaining everything afterwards, where you can get the archived information. It's always posted pretty quickly afterwards, but we'll make sure that that's made maybe even quicker than normal, because I know there's this problem here for folks. All right. Normal investing. All right, for those of us that are investors, maybe we have 401ks or portfolios, or we're investing for our kids or retirement or whatever, college education. A traditional approach to investing is simply buying a stock. Okay, if we're dealing with stocks, we're simply buying a stock. We might buy a mutual fund, ETF, whatever it is, but we're just buying it. Okay, we go out, we put the money down, we may pick it up on margin, but we're going to buy it. All right, if the market goes up, we're geniuses. Okay, At least this is how I look at it. When we go down, the stock's a piece of junk, okay? But the point of it is, when we take this particular approach, is that our success is 100% linked to market direction and magnitude, okay, of the movement immediately, okay? So if the stock goes up a buck, we make a buck times, we bought 100 shares, we make 100 bucks. We bought 1,000 shares, we make 1,000 bucks. It's very linear. The risk is very linear in the world of stock-only investing. Okay, for those of you that trade options, you know that there's other aspects of risk that we have to address in the world of options. We deal with data and vega and other things that as we characterize the risk in options, it becomes less linear. Okay, there's other things that drive the profitability of an option trade besides market direction. Okay, but when we just buy stock, and believe me, I do it too in my 401ks occasionally, it's just, we buy and we want it to go up. We sell, and if we're going short, we want it to go down. All right, barrel number one, sell puts. Okay, I'm not going to go over option theory too much today. What options are, what a put is. I'm going to assume, at least for this conversation, that people know what a put is. Okay, when we sell a put, though, we have the obligation to buy the underlying at a predetermined price over a predetermined time if assigned. Okay, put sellers have the obligation. Put buyers have the right. As put sellers, we have the obligation to purchase, if we're doing this on a stock, and we're going to talk on stock today, but it can be for any underlying. We have the obligation to purchase that stock at a predetermined price, the strike price, over a predetermined time if we get assigned, okay? So if the thing is, 60 days left in the option, and it's most stocks are American option, meaning you can exercise the option anytime between now and expiration, we have the obligation, if we happen to get assigned, we got to buy the stock at that strike price. That's how it goes. That's part of the game. Okay? The compensation, though, that we get as a put seller for taking on the obligation is that we get paid. We get paid by the put buyer. All right? We keep that money no matter what. So as soon as we get paid, as soon as that transaction occurs, it goes into the clearinghouse overnight, that money gets flushed into our cash account. That's our money. We can spend it. Okay, so that's the put. That's the put selling. Okay, and we utilize that tool an awful lot. I utilize that tool for my clients. We talk about that in the mentoring program about selling puts as a way to, as a trade vehicle. Okay, as a way to collect monthly income from the premium, or for those of us or those of you on the call that are interested maybe in accumulating a portfolio of stock, we address how to, the strategy behind selling puts to accumulate, whether it's stock or some people go ETFs or whatever it is. Okay, it's a powerful strategy, and a strategy that's getting a whole bunch of press lately too. Over the last year or so, maybe a couple of years, it seems like suddenly everybody's talking about put selling. So, all right. So we have two possible outcomes when we sell puts. Two possible outcomes. Firstly, if the stock closes below the strike price, okay, as put sellers, we're going to get assigned, and then we buy the stock at that particular strike. Okay, so for example, if we sell IBM at 100, if we sell the 100 put in IBM, I know IBM's trading way over that, but if IBM closes below 100, the put buyer is going to have the right to sell us or put to us that stock at $100, and they're going to do it if the stock is trading below 100. So we have to buy that stock, okay, and we pay that strike price. Our effective price that we purchase is going to be the strike price less whatever we got paid for it. So in the case of an IBM, if we got 100 put that we sold, so we had the obligation to pay 100 for that stock, but we collected $1, well, then obviously our effective net purchase price is going to be 100, take away the bucks, so we pay effectively 99 bucks. Okay. If the stock closes above the strike, there's no assignment. Okay, we do nothing. The thing expires worthless. And at this point, we simply calculate, we keep our money, and it really just becomes sort of a yield grab, how I would characterize it, a yield grab. A yield grab meaning that we're going to determine based on how much margin we have to put up, how much money we collected over that given amount of time, we might make a yield. Maybe it's 2%, maybe it's 10%. It just depends on, the strike that we sell, depends on timed expiration, and it depends on the level of implied volatility. Okay. The downside of put selling is on a large rally, we will miss the stock. On a large rally, we're going to miss the stock. And this has happened to me. It happened to every single person that sold puts. You sell a put, the stock shoots up massively. And of course, you keep your premium, you keep your $1 or 50 cents or whatever you collected, but meanwhile, the stock may have rallied 5 or 10% or whatever it is. So for some people, that's frustrating. It can be frustrating for anybody to watch that, but we go into that knowing that that's part of it. Okay, so I would consider that sort of a downside. All right. So let's take a look at Microsoft, for example. All right, and I pulled these prices off of Friday's close. So these are all real prices on Friday. So I looked at Microsoft and I looked at the September 34 put. Microsoft trading around 34.75. The 34 put in SEP was trading 63 cents. Okay, and if anybody's familiar with Microsoft, how those options trade, they're usually like a penny wide. So maybe it was 62, maybe it was 64, but they marked it on the close 63. So there we are. There's 29 days until expiration as of last Friday. Okay, I think today there's now, well, today there's going to be 26. The cost, if we are assigned, is again 34 bucks, the strike price. Take away that 63 cents that we collect, we keep that, which creates an effective net purchase price of $33.37. Is that right? That's right, right? Yeah. Anyway, $33.37. Okay. The yield is going to be based on the net margin, okay, that we have to put up. And the margin is calculated on these put sales based on an algorithm that the broker-dealers have. Has to do with the volatility and the price of the stock and, I don't know, some other mysterious black, secret formulas that they keep in a vault probably. But for this particular, for Microsoft, for that day, it looked to be about 621 bucks. So we simply calculate that yield, and it comes out to be 10%, 10.14% over 29 days, okay? It beats what my bank's paying. I don't know about you, but my bank pays like 0. So that's a pretty good yield based on what the margin requirement is for Microsoft over 29 days. Okay. All right. And if you've got a question, and I know that folks it's kind of a little bit confusion here with the audio, but just shoot it in the chat. And I will kind of glance over here once in a while. I got the chat right next to where the PowerPoint is, so I can kind of, look back and forth. At the end of the session, if we do decide to go into the software, then I can't see the chat, but I'll come back to it. Okay. All right. Somebody here says that acquiring stock, selling puts to acquire stock on a dip is smart. Selling puts is a terrific way to buy stock or ETFs or whatever the underlying is. It's a very effective way. And like I said, it seems like I'm hearing a lot more about it nowadays. Over the last couple of years, it seems like more and more people are talking about selling puts as a way to create a portfolio. So, all right, barrel number two. We're going to buy, you can buy a call. All right, that's the second way that we can accumulate or attempt to accumulate or purchase a stock or an ETF or whatever. But a stock is to buy a call. All right, now we're purchasing an option. Whenever we purchase an option, we have the right to buy that particular underlying stock, in this case, at a predetermined price over a predetermined time. Okay? Option buyers have rights, not obligations. Option sellers have obligations. Option buyers have rights. So as soon as I buy a call on IBM, I have the right anytime I want before expiration, if it's an American option, and stocks again there are some products out there that are European, the indexes, SPX, NDX, XEO, some of those, they're European, and when you've got a European option, you cannot exercise it prior to expiration date, but the American ones you can, okay, and all stocks are American. The reason they do that, there's a couple of reasons, but one of them is dividends. Okay, a lot of people want to exercise calls ahead of dividends, and that's a big option play. When I was trading on the floor, every day before ex-dividend day, there would be these guys that would jump in and do these what they call dividend plays. We buy deep in the money calls and sell similar deep in the money calls, same number, and then we'd exercise our call and hope the other calls didn't get exercised, and we'd be able to lock in a little bit of free money there if that was the case. But you do see in the money calls, fairly deep in the money calls, get exercised ahead of dividends that could occur prior to expiration. Anyway, we pay for this right, okay? Call buyers, obviously we're buying options, we got to go in our pocket and pay. So we pay for that right. There's two possible outcomes here. Okay, one is that the stock closes above the strike price at expiration. In that case, we exercise and take delivery of stock. Okay, I got a smiley face there, that's a good thing. So IBM again, we bought the 90 call, IBM's trading 105 or whatever. We get to exercise, we get the right to buy IBM at 90. So that's what we do. We buy IBM at 90. We make $15 cap gain there. Stock closes below strike price at expiration. We let our call expire worthless. Okay. Anybody who's traded calls, especially out of the money calls, has had this happen. The thing about being a call holder or an option holder is not only do you need to be right in your direction, but you need to be on time, okay? I can't tell you how many times I've put a strategy on or whatever, and I happen to be long calls, and it's the week after expiration, the call that I was long is now gone, the stock decided to rally above my strike price. So you have to be aware of the fact that, and anybody that trades options knows this, but our profitability is not only dictated by the direction or the magnitude of the move, but by the timing of the move. Okay. All right. And let's take a look at Microsoft here. We'll go back to it. Same price, same day. The stock again was trading. It closed $34.75 on Friday. We'll look at the set 36 calls. So now we're looking a little bit out of the money. Okay, it's like the next strike out of the money, I think, or two strikes out of the money, I guess. There's 29 days. These calls trade at 45 cents. Okay, so the net cost of this stock, if we exercise, is going to be 36, which is our strike price, plus the cost of the call, which is 45 cents. All right. So that creates our net price of $36.45. Whenever we buy an option, that adds a burden of additional costs above the strike price. Okay, the puts, it kind of buffered us and made our costs less because we got paid. But in the case of the debit, it costs more. All right, clear? All right. All right, look at the double barrel trade here, the double barrel trade. What we're going to do here is we're going to sell a put and buy a call. Okay, we're going to sell the put and we're going to buy a call, same trade. Now, just as a kind of review here, the pros of the selling the put are we get paid. I like to get paid. I'm sure everybody on the call loves to get paid. We all like to get paid. We get to pick our strike, our price. I mean, that's sort of typical with options, but we pick our strike or our price. The net is always below the market price if there's extrinsic value. Okay, and you're never really going to sell an option that doesn't have some extrinsic value to it. Okay, but that extrinsic value goes away at expiration, and that's how we get paid, is by extrinsic value. Okay, so our price is effectively always below whatever the current market price is. Okay, it can create a nice yield if the option expires worthless, like what we saw in the Microsoft puts. The cons, though, are if the stock rallies hard, we miss the stock. Now, that's never happened to me. No, I'm just kidding. That's happened to me a bunch of times. But we miss out. Okay, we're high-fiving ourselves, you know, after we sell our put, and the puts kind of go to zero, and we're feeling pretty darn good until we realize the stock, you know, rallied 10%. We made, you know, 1.5 or 2%. But that's the downside of puts, and that's, like I said, that's part of it. If the stock falls hard, we're gonna realize a loss. There's nothing really we can really do about that, with other than buying a further out of the money put, which really can, you know, really change your risk return profile and really eat into your yield. It's not what I do. I don't normally just sell put spreads, but someone could. But obviously, if we're short puts and the market craters, you know, 30%, and we buy our Microsoft, for example, put stock at 33, you know, whatever, 80 or something, and the stock goes to 25, we're still going to feel pain. So we do have downside. Somebody noticed and took note to that selling put and a buying call is a risk reversal. Yes, this is a risk reversal, Joe. That's exactly what we're talking about here. It's a hybrid synthetic long stock is what we're going to create here. And I'll probably have time here. I usually take about 40 minutes for these things and then a few for questions. But I'll probably have time to go and model this out. We'll take a look at the deltas and the Greeks and stuff. But you'll see that that is exactly what this is. It's called a risk reversal. All right. The buying the call. What are the pros? The pros are limited downside. If we buy a call for 50 cents, the most we can lose is 50 cents. Unlimited upside. Those are good things. The cons, if the stock does, like we said before about the sort of the timing thing, if the stock does not move, you know, hard and fast upward, not hard and fast downward, but hard and fast upward, we lose our investment. Okay, so there's this time element involved. And it is a decaying asset. All long options are decaying assets. And for those of you that are either part of the mentoring program or looking at it or just know options in general, that time, that decaying aspect, or that theta we call it, is a big part of the profitability profile of options. You can create strategies around theta, around time decay. So, but when you're short the option, it works in your favor. But when you're long the options, it works against you. Okay. How do you lose on the call if the stock rallies hard? You don't lose on the call if the stock rallies hard. What I said was if the stock does not move hard and fast upward, meaning if it doesn't move hard upward fast, we can lose. It has to go quickly. I mean, not quickly, but it has to go by the time expiration is. Yeah, I mean, if this thing, you know, if we buy calls tomorrow and the stock screens up 50%, we're we're going to be feeling real good. So you need that upward movement. You need it within that timeline. All right. So depending on the strikes chosen, selling a put can pay for the cost of a call or even create a credit. Okay, I'm going to show that here in an example in just 1 second. All right. We take the stock if the stock drops below the put strike or the stock rallies above the call strike. Okay, those are our two triggers. We exercise our calls if it rallies above our strike, and we get a sign on our puts if it falls below our put strike. Our puts are always going to be below our calls. And then if the stock settles between the put and the call strike in that middle area, both are going to expire worthless. And then we're left whatever the debit or the credit happens to be. Okay, so there's really three different outcomes. All right, let's look at Microsoft. Let me just take a quick drink. It's going to be, I don't know where everybody is, obviously, but I'm doing this from the Chicago area. I'm looking at my thermometer here on my computer. It's 89. They're saying tomorrow it's going to be 97 degrees here. So wherever you are, I hope you're staying cool. Anyway, Microsoft. Let's take a look at an example. This is going to be from the same prices that we took off of Friday's close. So let's work with that risk reversal. Some people call them split combos. That's another term I've heard. Some people call them hybrid synthetics. I don't know. You call it whatever you want, but what we have here is we're selling 1 September 34 put for 63 cents. We'll use those prices that we had on the close on Friday. Okay. Again, the stock was trading at 34.75. I probably should have put that up there. I forgot. All right. So 34.75 Microsoft, 34 puts trading at 63 cents. So slightly out of the money put. Okay. 36 call. We can pick those up for 45 cents. 45 cents. So we got a net credit of 18 cents. Okay? So we get paid to put this trade on. All right. The possible outcomes, we got 3. If the stock closes below 34, okay, the puts are going to be assigned. In that case, we buy the stock at 34. Take away the 18 cents, or 33.82. Number 2, if the stock closes above 36, we exercise our calls. Okay, we exercise our calls. Remember, we own the call. We have the right to exercise those calls. With the puts, we have the obligation to buy that stock. But we exercise our calls. We're going to buy the stock at 36. We took the credit in. So since we have a credit, that's going to lower our cost basis by 18 cents. So it's really 35.82. If the stock closes below 34, not below, if the stock closes above 34 but below 36, we do nothing. The calls expire worthless, the puts expire worthless, and we simply keep our 18-cent credit. So that's not so bad either. 74 and Boone. I like North Carolina. I've heard great things about the climate in North Carolina, in Colorado too. So, all right. I'm going to go back. What I'm going to do, I'm going to go over to my. I think I am. We got a little bit of time here. I'm going to jump over here and I'm going to share my desktop. I hope I got the right thing up. Let me just. Whoops. Okay. Playing around here. I'm going to share this, and we'll just show this on the computer. What I've done is, come on, there we go. All right, you should all see a matrix, and magically, it's Friday's close in Microsoft. See how swiftly I did that? Between the time I went over and pressed that button until it came up, I went in there, brought it up, went into BackTrader, set this trade up and did all of that. All right, Microsoft closes Friday at 34.75, and here's our matrix. You can see for September, okay, and for those of you that aren't too familiar with this, real quickly, up here, I hope you can see my pointer. Microsoft 34.75 is the price. It was up 2.36 on the day, thanks to Mr. Steve Ballmer announcing the fact that he was going to be leaving in 12 months. We can see here that along this left margin, you can see that we have the strike price. The C represents calls, the P represents puts. The numbers are the strikes. We have market prices right here. MIV is the midpoint of the implied volatilities, and these are deltas. This is September options, these are October options, and these are November options. But we're going to focus on September today. So what I did is I just put this trade in. This is our trade, basically. And you can see that I basically bought the calls for 45 cents, and I sold the put for 63 cents. Okay, and let me just point out a couple things. You can see the gross requirement on this, or the net requirement is 667. That's sort of calculated by the software. Okay, every broker is a little bit different on that. But what I want to just point out a couple things here. The Greeks. Okay, we'll just observe the Greeks here. We've got a delta here of 66. So this is not, because we're splitting these strikes up, we have created less than a share of stock, effectively. If we sold 134 put and bought 134 call, we would have 100 delta there. We would have created a synthetic share of stock, but we split them up, and the deltas of the put and the call are less than 50. You know, they only add up to 66. So there's the delta. You can see it's short a little bit gamma. Okay, again, the put is the short strike. It's a little bit closer to the at the money than the call, so we're going to be short a little gamma here. Depending on what you're using the strategy for, that's not such a big deal, really. We're collecting a tiny bit of theta, 16 cents, and then it's a little bit of short vega, almost minuscule. So, but there's the trade, and what I'll do is I'll click on this Analyze button right here, and what this is going to do is give us a risk profile or risk graph of how this trade will perform. And what I've done is I've just, for simplicity purposes, all I've done is just made this the expiration curve, what we call a parity graph. But this is where the trade is going to end up on the P&L curve at expiration. So in 29 days, okay, this left margin right here is our P&L, our profitability. This horizontal x-axis, that's the x-axis, right? Yeah. The x-axis, the horizontal axis here is the price, and then right here we have a conversion over here to into percents. But you can see though that this represents our little hump right here. This is our 36 call strike, and you can see once we're above 36, we have just a call. It's in the money call that's going to operate just like a share of stock. Okay, or a call that is in the money. If we break below 36, the call's worthless. The put is still worthless as well. It's out of the money. But here's our this represents our little 18-cent credit. It says 16 because it calculates commissions too. But so there's our little no man's land where if both expire worthless, you can see that at expiration, okay, we're going to keep our 18 cents or 16 cents. Okay. Here's the strike price of the put, 34, and you can see that as we break, that is now going to basically act like the other half of the long stock, and we're going to lose money on sort of a one-to-one ratio. Okay, and the break even is just a little bit under 34 because we've got that credit. So 18 cents or 16 cents under that. But that represents graphically how this trade performs. Okay, and I could add some lines in here, some T lines. You can say that, you know, I'll just put 3 in, but this is going to be how the model represents this trade behaving in terms of profit and loss along this range of price. Today, T0 represents today, and then it's 15 days from now is T15. It'll show like it's pretty close. It's not really going to. There's not really a lot going on here as far as options, so you're not going to have a whole bunch of lines moving around. Okay, it's a pretty straightforward trade. But that's a trade. That's the synthetic, the hybrid synthetic, the risk reversal, the split combo, however you want to do it. But that's our trade. Let me go back and let me try to get back to the other thing. Okay, so I'm back to the PowerPoint. All right, so that was graphically it. Okay, let me see here. I got a couple of comments I think on the chat before I bring into the final. Yeah, I know we got no voice. We're going to have to get with WebEx and see where we can get this thing. This is very frustrating, and I apologize to everybody for that. Let me I see a few comments going on here. Let me just go through some of the final thoughts. I'll wrap up just my last few comments here, and then I'll get to the chat. We got some time, and I'm always excited when people have questions and stuff about this. Some final thoughts. The net credit or the net debit that we put this trade on for will depend on several factors. Okay, it's going to depend on our strike selection. The further out of the money that we go, either with the call or the put, are going to affect how much we pay or how much credit we get for either the call or the put. Okay, and that relative distance that we have is going to affect it. Implied volatilities and skews, okay, and time until expiration. Those are the three main factors that are going to affect the credit or the debit. All right, and then final thought. I did it today with September. You can mix and match months. Some people like to do maybe a put or the call in the front month and the put in the next month, or vice versa, or whatever. They play around with it. But be careful. Watch your risk return profile. It changes. Okay, especially if you sell the put in a further out month than where you buy the call. You may have a supercharged margin requirement by your broker dealer, okay, because they will get freaked out because they'll look at your thing and they'll say, well, this guy's got a call, but it expires, and they'll look at that put and they get nervous. So sometimes that could be affected. I know it's affected on the spreads and other things, and some on the collar sometimes. So just double check with that. Sometimes it doesn't make a huge difference in these kind of trades, though. Short put means potentially large downside risk. We already been through that. The vertical skew in the equities can help this trade, as puts tend to be more expensive than calls. In the equity world, puts always trade, and what I mean by puts is the strikes below the at the money always trade at higher implied volatilities than the strikes above the at the money. And that's a result of people being essentially long shares of stock in their portfolios, and people get more nervous for sell-offs than they do for rallies. And just as a little, tidbit for whatever it's worth, that skew was very flat prior to October 19th, 1987. Okay, and probably a lot of you were around, or maybe in elementary school or whatever back then, but I happened to be trading back then. I just started. But there was a very flat vertical skew between puts and calls prior to 87. People just never expected anything like a 20% or 22% sell-off in a day. Ever since 87, we have this exaggerated vertical skew, and as the gentleman pointed out earlier, the person on there, this is essentially a hybrid synthetic stock. Okay, we're creating a synthetic stock, not a full stock because we didn't have 100 shares and it didn't continue to operate as a 100 share under Delta underlying. But that's essentially what we've done, is that's what we've created. So anyway, it's kind of a cool strategy because it allows you to collect the stock on 2 different points. You can, like we saw in Microsoft, you get paid if nothing happens. If this thing screams up to 37, you're going to be happy because you own this thing. And if it goes down, okay, well, we're buying it, but we know we like it. You know, Microsoft pays a pretty good dividend, and you calculate what your dividend yield is at say 34 or 33, 78.5 or whatever it was, and you're happy you own a Microsoft at that point, then you're happy there. So it really does a nice job with eliminating missing that stock on the rally, but at the same time, you're not stuck with some, you know, option that you're sucking the life out of you every day that the stock doesn't move, meaning owning calls that decay every day. So anyway, that's what I have. I'm going to hit the chat here and see what kind of comments we got. Let me go over here and see. Let's see. I'll just go back up here to the, okay. Let me see. 74 in Boone. I love it. This trade would be made only if we expect the stock to go up, right? Someone said if this trade is only to be made if we expect the stock to go up, right? I would say this is a bullish trade for sure. You know, like I said, the cool thing about it is if the stock rallies hard, we still have a possibility of getting in the stock as opposed to being, you know, selling these calls. You know, you see the stock go all the way up, but you're sitting there with your, you know, 40 cents that you made or whatever, which isn't bad, but this is a kind of a cool way to be able to capitalize if that stock just takes off. And additionally, you know, if it doesn't do much, you're not getting crushed by theta by owning things. So yeah, it's definitely a bullish. It's definitely a bullish trade. Or would we really want to own the stock? Yeah, I would say that you can do this as a trade. Any of these strategies really you can do as a trade. It's a terrific way to build a portfolio, but you could also do this as a trade. I mean, you take, you know, you take delivery of your stock, for example, if the calls go in the money. Well, it's real easy just to sell the stock. You can sell more calls against it. You can do all kinds of things. I mean, if it's Friday of expiration and it's 2:59, I'm on Central Time, so we close at 3. If it's 2:55 and you know your call's in the money and you know you're going to exercise, well, you got all kinds of options. I mean, you could sell the call in the close, take your money there. You could take the stock. You can sell, you know, maybe the next month out call. You know, you can do all that, but you can treat it as a trade for sure, or you can use it as a way to build a portfolio of stock. Let's see, what should an ideal time to get into such a trade on a stock? In other words, should it be just like Microsoft when the stock has gone through a retracement and it's now bouncing? The question is when is a good time to get in it? When would you implement this type of strategy? Should you look at some technicals or something like that, a retracement? I'm not a market technician, so I'm probably not going to be able to comment too much on the timing of this trade. We have an awful lot of students and folks that come through here that have their own technical analysis that they use, and seems like there's for every 100 guys that come through our doors that are traded technically, we got 100 different technical combinations. So my answer to you, Raj, would be whatever you feel is making you sort of you want to be bullish on the stock. For whatever reason that is, it's probably not a bad time to put the trade on. You know, whether you're bullish because it's retraced, or whether you're bullish based on some fundamental, or whether you're bullish based on dividends or whatever it is, I don't know. But it is certainly a trade that performs, is designed to perform better in a more bullish environment. We certainly don't want this, going back to Microsoft, we certainly don't want to see Microsoft go to 25. Okay, we're going to own the stock at 33.80 or whatever. You know, we're not going to be all that happy owning at 25 probably, but that happens. But yeah, you got to use your technicals. So how do you analyze when to get into such a trade or to use Greeks, and if so, how? Well, I'll tell you how I do it, and you know, but I tend to take these more as portfolio building strategies myself. I look at the stock. Okay, Microsoft happens to be trading, paying a terrific dividend. Okay. So what I'll say is, okay, if I buy Microsoft, am I happy owning Microsoft at 34? If I own Microsoft at 34, what's my dividend yield going to be? It's going to be, you know, 3% or whatever it is. Okay, that's good. I'll take it. And then if I happen to be, you know, if I pick the 30, then usually what I do is I use the call. I buy the call so I get a small credit for the put. That's how I ended up picking those 36 calls. So I didn't want to go out of pocket for the spread. But I started with the stock and then create the structure of the options around owning the stock. Others will use their technicals and say, I've got a bullish signal on Microsoft or whatever, and then go into the options. You might look at the implied volatility, you look at the distance from the at the money and determine, okay, these are the strikes I want to go. I mean, because you get paid more on the put. So all else being equal, you can put a trade on for a credit. If the put's $1 away from the at the money and the call's $1 away from the at the money, you're going to get paid for it 98% of the time because those puts are trading higher. So if you start with your technicals, then look at the implied volatilities and figure out that, and look for when you think your technicals are telling you where the stock is going to go too. That will help you set your strikes. You get to use Greeks. I think boy, hold on a second. I think I'm losing some of these questions here. I think I answered that one. How do you analyze them and get into use Greeks? Yeah, I kind of use, like I said, for me, Greeks, we use this as a portfolio building strategy, so the Greeks aren't that big of a deal. I don't worry too much about them other than I hate paying time decay. Just, I can't stand it. Okay, so do it if you're, well, if you're feeling bullish. It says you do it if you're feeling bullish. I don't mean that I feel it like I'm feeling bullish, you know, whatever analytics that you're using that's making you bullish on a stock, or even if you're unsure, I mean, but you need to be sort of bullish on it, or at the very least that you're happy owning the stock. That's what you want to do, okay? Because chances are you might own the stock. Okay. Good for doing when bull flag is forming. Okay. There's a technical. Like I said, we've got so many folks that come through here with different technicals, and I'm not qualified at all to comment on technical analysis. So anyway. All right. Well, enjoy the heat. Yeah, I think tomorrow, if we did this thing tomorrow, I'd probably set up in the backyard when it was like 97 degrees and my cold iced tea or something. No, I'm going to be staying cool. But all right, I think that is it. It's been a pleasure as always. I always enjoy these. I hope I got everybody's question, and I apologize again for our audio. I promise we'll get this thing figured out. That's just the mystery of technology sometimes. It works every day, and then all of a sudden, for some reason, it doesn't. So we'll fix that. And this thing will be available and posted very quickly. So anyway, enjoy the remaining of the short week. Remember, our options, they're going to be taking a lot of beta out of these options probably Wednesday. So if you happen to be a trader, keep that in mind. And that's it. Thanks. Have a great day.